Last week in the S&P 500, we saw their 6-week win streak come to an end. In fact, pretty much red right across the board. However, the biggest winners were in fact Tesla shareholders, up 22% on the week. And as we can see, the market clearly did like their earnings, something we will briefly touch upon today. One area or one industry, in fact, that did suffer, we see aerospace and defense. Again, these companies also reported. We have GE down 7%, Lockheed Martin down more than 8%, but we do have some news to share that we think may, in fact, see these losses start to recover over the next few days. Now, in terms of the fear and greed index, where is the market sentiment? What exactly is going on? Well, what we can in fact see, something that we like to look at once a week. Right now, we are sitting in greed. In fact, just a week ago, we were sitting towards extreme greed right on the border. Now we can see it is starting to move into neutral, and we do believe with earnings continuing, in fact, possibly the biggest week of this earnings season, we are going to get a lot more volatility right across the board. And don't forget, the US presidential elections are only weeks away, so definitely something to take in consideration. Now, today's episode, we are looking at 8 undervalued dividend stocks with massive growth potentials over the longer term. We'll look at their historical performance. We're going to touch upon their earnings expectations moving forwards, their historical forecasting accuracy. We're going to touch upon some metrics like their dividend safety, look at some valuation models. We're also going to talk about dividend yield theory, compare their forward P to their 5-year average, which can also give us a sign of undervaluation, as well as some very important metrics like their free cash flows, like their ROICs, and many others that you need to understand the companies you're considering. And as always, we are going to run them through each one in the valuation model, get to our own intrinsic value, talk about our margin of safety, do we see 5, 10, 15, 20% or more, and get to what Wall Street believe in terms of just over the next year, how much growth they truly see for each one of these companies. Now, just some market updates before we start. As we can see, in fact, after the market close on Friday, we saw Israel hit Iran with airstrikes. As we said, we would expect this to impact the market depending on how far this goes over the next few days. And in turn, we may see share prices increase for those defense companies that we talked about that had a poor week in the S&P. We also have very interesting news. Now, the New York Stock Exchange is trying to do something fairly similar to what we see in the crypto world. They're talking about extending their trading to 22 hours a day. So, whether or not you believe that is a good idea, let us know your thoughts in the comments below. It could be something that's very stressful. Imagine waking up early hours of the morning, you go to look at your stock and it's down 10-15%. Again, some people may love this, some people would just prefer what we originally have. As always though, let us know your thoughts on this. Very interesting news. We had some unfortunate news. The Control for Disease Centers, CDC, essentially saying McDonald's in fact has been linked to an E. coli outbreak coming from their quarter pounders. And unfortunate news, there was 10 hospitalizations and we saw 1 death. In fact, whether or not this is the end of the conversation or in fact it will start to increase, we can see right now where this is spread. As we said, the share price did fall, although did start to recover, a video we have in fact released over the last few days. We also noticed Starbucks doing something very interesting. They've released their earnings earlier than when the market was expecting. Preliminary results, however, we are expecting the full results to come after market close on Wednesday. Not great in all honesty. They had a 10% drop in the footfall traffic in their North American stores, and they did have what we would consider to be some very large misses in terms of the earnings per share, in terms of the revenue. As we can see, they reported 80 cents EPS, market was expecting 103, and we also note their revenue also coming under 9.1 versus the 9.38 billion anticipated. Now, they also mentioned 7% decline in same-store sales, the biggest drop since the COVID-19 pandemic. But the main thing that we really want to take away from here is that the footfall is falling significantly. Less people are entering their stores, and China, which is their second largest market, in fact, their same-store sales came down around 14%. Not great, in all honesty, if you are a shareholder, and we also can see something that essentially is typically fairly bearish. They have decided to suspend their outlook for full year 2025, given the fact they do want to implement a new strategy, which they believe will take time. The only good news that we have to say coming out of this is that they have increased their dividend by around 7%. Then we move on to Tesla. As we said, very, very strong, especially in terms of the market reaction, more than 20%. And they reported numbers that were better in terms of the earnings per share than what the market were anticipating. 72 cents is a very large beat in comparison to the 58. Revenue as well, it did come slightly under, but the market wasn't really too fussed. They saw growth in the EPS. They also saw growth in terms of the margins. And as we can see, their revenue is moving in the right way, and their free cash flow also looks to be good. Now, we're not covering McDonald's, Starbucks, or Tesla, so if you want a deeper dive, do go check out the videos that we have released over the last few weeks in a lot of detail covering all three companies. Now, the first one we are jumping in today is Coca-Cola FEMSA, ticker symbol KOF. Now, maybe not one you have heard of. They are the largest distributor in terms of bottling company for Coca-Cola company itself. We notice over the last 12 months, it is up around 17%. Over the last 10 years, now they are down around 19%, but again, we do believe this is high quality, as we will come to show you. And as always, remember, will depend at which point you bought. For example, from the COVID drop in 2020, it was trading at $38, now more than double that position. In terms of the 52-week range, it is now trading towards the mid to lower end. We get a double buy rating from Seeking Alpha and Wall Street with a hold from Quant. We get a forward yield that sits just below 3%, a forward PE of around 15. Remember, S&P right now is trading at around 25. And when we do take a look essentially at the earnings expectations, moving forwards, they are expecting the next 2 quarters to be negative, although quarter 2 and quarter 3, they expect this to pick up. What we always like to see, historical forecasting accuracy looking very good, 100% track record. They have outperformed management targets over the last 4 quarters. And with growth expected into December 2025, the forward PE is expected to come down to around 13.2. Now, as we said, we're going to look at these metrics for each one of these companies. Their dividend safety score sitting at 60, borderline safe, which we will touch upon. We're going to look at these two models, and we see they have increased the dividend over the last full year at 5%, above that 4% inflationary target. Now, it was reaffirmed, this score, in May this year. Essentially, what it means is there's a moderate risk of a dividend cut over a full economic cycle, but we will give our thoughts as well. Now, for each 8 of these companies, we are going to run through some key metrics, essentially how they performed during the latest recession, 07-09. Well, Coca-Cola FEMSA, they increased their dividend. They had plus 0.7%, which was above the average of the S&P, coming in at negative 12. They also significantly outperformed the S&P in terms of return, negative 36 versus the S&P's negative 55. Not the greatest increase over the last full year. Reason though, as we can see, while we weren't too happy, double-digit growth over both the last 5 and the last 20 years. In fact, on average, over the last 20 years, they've been increasing the dividend by 17% year on year. Now, they have been increasing those dividends for the last 6, whilst paying a dividend for the last 20 without a reduction. Now, in terms of this valuation model, though remember we will get to our own one, what we do notice here, the blue funnel essentially being the expected fair value. Right now, we see it trading right towards the lower end, and we do believe, as we will come to show you, there is a nice margin of safety and significant upside. Now, typically, dividend yield theory tells us a company is undervalued when the current yield sits above the 5-year average. This model isn't accurate at the moment. As we can see, the yield is more towards 3%, so not something we will consider for KOF. However, in terms of the forward P, right now around the 15 point, it is marginally lower than the 5-year average of 15.9. It is also lower than the consumer staples sector P of 18.3. Now remember, we're not looking at any one of these models in isolation. We will conclude towards the end when we put it through our own valuation. Now, free cash flow, every metric we're looking at today, we're going to ignore the earnings. It is susceptible to manipulation by management through accounting. Below 70% is what we want for consumer staples. That is what we get every single year, 59% in 2023, expected 24% over the next 12 months. So we do believe moving forwards, we will start to see those double-digit increases we've come to love with this company. In terms of free cash flow, we want consistent increases over the longer term. Now, we get nearly double from 2014 to 2023. Not very consistent, but over the longer term, it is moving in the right direction. Then we get to the sales growth, their top line, where we want a minimum of 3 to 7%. Remember, 3 to 4 just to keep up in line with inflation. Otherwise, it is decreasing in real terms. Last 3 years looking very good. Trailing 12 months as well at 10% is fairly positive. And when we do zoom out and look at it from the last 10 years numerically, we can see growth 147 billion to 245 in 2023. Now, shares outstanding, always a metric we consider. We want to know, do companies in their own capital allocation return excess cash to shareholders through those share buybacks? Now, they have diluted your position, but very, very minimally, in fact, by 3 million shares over the last 10 years. And in fact, since 2018, it hasn't moved, so not really too much to discuss. It isn't part of what they like to do with the capital they have in their company. Now, talking about capital, ROIC, return on invested capital, we want 12% or more. Very important metric, giving us faith management are able to effectively allocate their capital. And we can see from 12% in 2014, 16% in 2023. So it's been increasing over the long term and looking very strong as well. Something we do pay particular attention to on companies we want to consider adding. Then we move on to operating margin. At least 16% is what we want for the industry. We also want to identify companies that have efficiencies, increasing margins over time. What we notice, very, very consistent. No surprises here. Remember, they are supplying bottles to, in fact, Coca-Cola. So we do anticipate there will be agreements. Hence why 14% is pretty much the norm over the last 10. Free cash flow margins, well, looking very good, above the minimum 7% on a year-on-year basis, 8% on a trailing 12-month. Then we get the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 4 is what we want to see. Remember, this correlates to dividend safety and balance sheet strength, and the numbers below reflect the number of years it would take the company to pay off all of their debt net of cash on hand. It's been decreasing pretty much since 2014, 1.03 in 2023, 0.67 on a trailing 12-month, 0.63 expected over the next 12 months. So this tells us the balance sheet is very, very strong. And with this number, as well as that free cash flow payout being low over the next 12 months, we believe their dividend is very secure and the balance sheet also looking very healthy. So let's jump into the valuation of KOF. And if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, to get our intrinsic value of $132, typically on this channel, we do deeper dives. We run through each model. We go through the inputs and the outputs. Today, just going straight into it, intrinsic value 132, average of these three. Now, we always like to do a margin of safety on this channel, and we start off with 10%. Now, we execute on this if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, we'll buy up to $118. Then we keep going till it's near the current trading price. And what we can see in today's episode for KOF, you are getting pretty much a 35%, in fact, bang on 35% margin of safety, with Wall Street indicating 30% upside over the next 12 months, their price target $111. Now, as always, do give us your thoughts about these companies as we go along. Are they ones you're looking to buy? Maybe you've started to buy. Maybe they're going to be on your watch list, or for whatever reason, over the more recent period, you have sold them. Now, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover what's gone on in the market, as well as undervalued stocks that we do believe deserve your attention. So do click on the pinned comment below, sign up, and you can start reading straight away. You will also be able to gain access to 36 undervalued stocks for the month of October, where we run through a lot of information, talk about the upside that Wall Street see over the next year, as well as those that sit within our own portfolio for those that are interested. And you can also grab a copy of 22 undervalued dividend stocks that Wall Street themselves believe have the most upside right now in the market over the next year. So as we said, click on the pinned comment below, sign up, and you can start reading straight away. We then move on to the pharma giant, which has been dipping as of late. It is a double buy from Seeking Alpha and Wall Street, where they hold from Quant. It is Novo Nordisk, in fact, ticker symbol NVO, now trading towards the lower end of the 52-week range. A forward yield of 1.28%, a forward P that does sit high at 34, but we are going to show you this is a very, very high quality company. Over the last year, up 16%. Over the last 10 years, significantly outperformed the S&P, up 405%. And as we can see, just over the last month, it has dropped down around 11%. Now, in terms of their earnings, when we do look at it from a historical basis, they actually missed their more recent quarter, although marginally, by 7 cents. Therefore, they have a 75% track record, 3 out of 4 beats. And we notice the next 2 quarters, they are expecting to close out 2024 with double-digit EPS growth. And December 2025, that EPS target will lower their forward P to 27.71. Then in terms of dividend safety, well, the highest score obtainable today, 99, very safe. We're going to run through these models as always, and as we can see, a company that doesn't mess about, they increase their dividend at a very, very rapid rate. Now, for those that want to know, dividend score of very safe, effectively meaning a dividend cut is highly unlikely. Now, in terms of some key metrics, as we can see, increase the dividend. They had plus 6.1% in terms of recession sales and massively outperformed the S&P minus 27%. As we can see, they don't mess about when it comes to dividend growth, increasing it for the last 20 years at 21% on a year-on-year basis, and they are officially a dividend aristocrat with more than 25 years of consecutively increasing the dividend. Now, in terms of this valuation model, when we zoom in over the last year, this essentially goes to show us, in fact, for the majority of the last 12 months, this company has been overvalued. Right now, though, it is sitting at around the midpoint of that reasonable valuation. In terms of dividend yield theory and the forward PE, both of them, given they're not far off the 5-year average, reinforce that reasonable valuation. And we do note it is significantly higher than the healthcare sector at 16.3. But remember, this company trades at a premium, and we do believe in this case for NVO it deserves it. How much of a premium? Well, we're going to show you in terms of our valuation model. In terms of free cash flow, below 60% nearly every single year. In fact, bang on in 2023, a little bit lower anticipated over the next 12 months to 54%. And free cash flow, pretty much what we want to see, tripled over the last 10 years. Anticipated the growth to continue to 1860 over the next 12 months. And in terms of growth itself, some years are very, very good, some years are looking okay, and from a numerical perspective, when we do get to it, we can in fact see pretty much tripled from 2014 to 2023. On top of that, share buybacks is something they do fairly consistently, fairly trivially, nonetheless, still looking good, added bonus on top of that dividend growth. And when we look at ROIC, one of the best we have come across on this channel, just in the more recent year, 72%, and in fact they have hit triple digits before. Definitely something investors will love to see, potential, as well as those who are looking to add to their overall position. We then get to the operating margin, not only above 12%, but massive operating efficiency, 39% to 46% on a trailing 12 month. Free cash flow looking absolutely gorgeous, no complaints whatsoever. And then we get to the net debt to EBITDA. Nothing really to say here. I mean, it's very, very low. 0.1 in 2023, 0.06 anticipated over the next 12 months. So as we can see, an overall very, very high quality company. Now, our intrinsic value of $134, we'll show you how we got that today, essentially running it through the DCF model. We have the free cash flow year on year, the average growth around 11%. Moving forwards, we've gone for 16%, which is in fact below management targets, also below the last 2 years. As we can see though, we've got a low, medium and high. Based on the 16% with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, 134, giving it 18% upside. Now, as we said, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, but we'll show you for transparency at the 14%, an intrinsic value of 116, giving it 3% upside, and at the 18% point, 154, giving it 36. Anyway, we will take this through and show you at the 16% point in terms of margin of safety at 10%, a buy at 121, at 15%, pretty much where we see this now. High quality company, a lot of people may say that is sufficient. We'll just show you though at the 20% point, a buy at 107, at 25% at the $100 mark. Today's episode though, 15% for NVO with Wall Street very bullish. 37% upside, their price target $155, and as always, do give us your thoughts in the comments below. We then move on to another pharma company, it is Zoetis, with another double buy rating and a hold from Quant. Trading in the midpoint of the 52-week range, we see a yield which is around the 1% point, forward PE just below 31, over the last year, well, up around 10%, over the last 10 years, another one that has massively outperformed the S&P, up 409%. Moving forwards, they are expecting growth every single quarter. Looking back though, we do notice one miss, so a 75% track record. And with the earnings per share expected to chug along in the right direction, forward PE is anticipated to come down just below 28. Dividend safety score, well, 74. We will show you double undervaluation signal here and a very nice 15% growth to the dividend in December last year. Now, in terms of the last recession, they didn't actually pay dividend during this point, so no comparable data, but they saw massive recession sales up around 30%. Another one like NVO with some gorgeous increases to the dividend, 23% year on year over the last 10 years, and they've been increasing those dividends for the last 10 years on a consecutive basis. Then when we get to the valuation based on the forward P, we notice in fact it's sitting even lower than the lower end, so that is some severe undervaluation. And when we look at dividend yield theory, current yield above the 5-year average, forward P below the 5-year average, so another undervaluation signal there. In terms of the sector though, healthcare does sit much lower. Again, remember you do pay a little bit more for quality that is essentially above the overall sector, as we have come to show on our deeper dives. Free cash flow below 60% every single year. No surprises then why they can offer those lovely increases. 33% expected over the next 12 months. We also notice free cash flow per share increasing in the right way, looking very strong. Massive growth expected over the next 12 months. And when we look at the sales growth, again, looking very strong. This is really what we want to see at a bare minimum, the 3 to 7% target that it does typically hit. And over the longer term, it has doubled their top line, around 8.5 in 2023, with some returning of excess cash, as we can see every single year. Very small, but again, it is better than nothing, and we love to see this for companies that do offer very, very strong dividends. ROIC as well, looking very consistent, and we've mentioned it before, we don't mind paying essentially a bit of a premium for those companies that are consistent over the longer term. Margins above the minimum, again, operating efficiency. This is the sign of a high quality company, increasing their top line revenue, increasing their margins, and free cash flow as well, looking incredible, 24% on a trailing 12-month basis. We then get to the net debt to EBITDA, which is below 3 consistently, in fact, down from the highs of 2015, 1.24 expected over the next 12 months. And again, we can see pretty much good signals as to how they are able to consistently offer those very large dividend increases. Now, our intrinsic value today, $234. MOS level, well, 10% a buy at 210, 15% a buy at 199, at 20% a buy at 187, and in today's episode, not quite at the 25% point yet, sitting somewhere for Zoetis, 20 to 25%, with Wall Street again very bullish, $225 price target. They see 25% upside over the next year. Is this one you've started to buy? Maybe you bought it when we started talking about it towards the 52-week low, or for whatever reason, this industry isn't one you are considering. Do give us your thoughts. We then move on to another pharma company that's actually right now sitting towards its 52-week low. Wall Street are the only one that give it a buy. In fact, 4.42 isn't far off the 4.5 that would make them say a strong buy. So definitely one they are very bullish on. Forward yield around the 3% mark. Forward P around 13. And we can see over the last 12 months sitting flat. Over the last 10 years up around 81%. But it has pulled back from the 52-week high that we see of around $135. Over the next 4 quarters, 3 of them growth with 1 of them double-digit decrease. But as always, I do love companies where we do get forecasting actually looking very good. In fact, sizable beats every single quarter. Massive growth expected into December 2025, lowering the forward P to 10.7. We get another very safe dividend score at 90, with a dividend increase in November last year at 5.5%, meaning over the next few days for Merck & Co, we are anticipating another increase. Now, when we get to the key ratio, what we can in fact see, they maintain the dividend during the 0709 crash, not an increase, not a decrease, above average growth, -4%, and a near S&P return, -57. Over the last 5 years, they've been increasing that dividend at the 9%. Over the last 20, pretty much in line with inflation on a year-on-year basis at the 4% point. With 12 years of consecutive increases, remember the recession, they maintained it. Therefore, they have 53 years of paying a dividend without a reduction. Then we get to this valuation model where over the last year, we see it pretty much in the midpoint. So reasonable valuation, you could argue. Then we get to dividend yield theory and forward P. Again, both numbers not far off the 5-year average, so another reasonable valuation that has been confirmed. Although unlike the previous 2 in the healthcare, this one does trade below at 12.8. In terms of the free cash flow payout, well, definitely something to keep an eye on. It's something we've seen before where they have increased it by triple digits. When it is above 100%, this essentially tells us that management have paid out more in dividends than they've generated in free cash flow. Bit of a red flag indicator, although nice to note over the next 12 months, expected to come down to 38%. Free cash flow has been increasing, although very inconsistent year on year, and we notice expected to more than double over the next 12 months. Sales growth looking very inconsistent as well, 1% in 2023. This year expected to be a lot better, with 7% in terms of a trailing 12-month metric. Then we get to sales, where pretty much around 50% growth over the last 10 years, And whilst they do some share buybacks, we can see over the last 4 or 5 years, it hasn't really moved that much. Then we get to the ROIC, where around 10% is definitely there. We get 21, 26 over the last 2 years, 24% on a trailing 12-month basis. And with the margins, again, whilst a little bit bumpy, it is above 12%. And when we do zoom out, we do get operating efficiency. Free cash flow margin also looking very, very strong. Finally, net debt to EBITDA, whilst it did peak at 2.81 in 2023, it is expected to come down sharply to 0.87. In fact, on a trailing 12-month at 1.15. No surprise then why we see that very safe dividend score. Now jumping into the valuation for Merck & Co, $146. This is telling us straight away we are seeing a massive margin of safety of this company. In fact, nearly at the 30% point at $102. Is this sufficient for you for this company? It has struggled. The share price has been punished. Their earnings were missed in the more recent quarter. Wall Street, however, very bullish over the longer term. In just next 12 months, in fact, 33% upside with their price target of $138. 30% MOS, 33% upside. Is it enough to get you interested in Merck & Co? Do let us know. We then move on to ATKR, where we get a double buy rating, and this time Quant have moved from a hold to a strong sell. Trading right there towards its 52-week low. It is one that has started to recently pay a dividend, 1.5%. Forward P very low, below 6. Down 31% over the last 12 months. Over the last 5 years, though, massive up performance of the S&P, up 151. But as we mentioned, from the highs of April 2024, this has shot right down. In terms of why, well, first thing we can see, they are expecting the earnings per share for 2025 to be a decrease every single quarter, in fact, and they did recently, as we mentioned, miss their earnings quite substantially by 19%. So therefore, their earnings per share, as we can see, is expected to lower. Their forward P at 7.34 is increased from the current 5.91. Now, clearly, we do see a lot of upside, as well as, in fact, Wall Street. That is why we're bringing it to your attention. Dividend yield 1.5%, as we already just said, recent dividend growth initiated, and we can in fact see when we do get to their free cash flow payout, 6% on a trailing 12 month, 17 over the next 12 months, so they have a lot of scope to grow their dividend at a very rapid rate. In terms of free cash flow per share, it has increased very sharply from 2014, 15.2 in 2023, but no surprises, especially given their earnings, it is anticipated to drop over the next 12 months. Then we get to their sales growth, where we do see a 10% drop in 2023. In fact, we notice out of the last 10 years, 3 years where it has dropped down. And when we do zoom out, though, it still has doubled their top line from 2014 to 2023. Clearly, management do believe that their shares are very cheap at the current circumstances. They've been buying back quite a substantial amount just over the last few years. And in fact, from 2014, we can see it down quite significantly. So nice bonus, especially during the period where they weren't paying out a dividend. And in terms of the ROIC, looking very strong, not only above 10%, but on average around the 40% just over the last 3 years. Still, even with the drop on the trailing 12-month, 28% is looking very, very good. We then get the operating margin, where we see this increasing over the last 10 years. Last 3 years, again, looking very strong, even with the marginal drop on a trailing 12-month basis, and the free cash flow above the minimums that we want to see, around 5 to 7%, 18 to 17 just in the 3 years that have gone. Net debt to EBITDA, this is what we like to see, especially for companies that are struggling with their earnings, with their top line, that they don't have a lot of debt, and in fact 0.47 in 2023, a jump to 0.96 over the next 12 months is still below that 3 that we typically want to see. And as we can in fact show you today, that Wall Street do believe a lot of upside after the massive drop. They see this as an overreaction by the market, 40% upside, price target of $120. We also have our intrinsic value that came to something very, very similar, which means in today's episode, we are getting a very large MOS, very similar to Merck & Co that we just ran through, and you are getting pretty much 30% around the $85 mark, 40% upside. Again, is this one to interest you? Also, do let us know if you want us to do a deeper dive on this company, as it is one we haven't covered in quite some time. We then move on to the railroad company. It is Union Pacific Corporation. Double buy rating with the hold from Quant, pretty much trading in the mid to lower end of the 52-week range, a forward yield of 2.33%, a forward P of 21. Now it is up around 12% over the last year, over the last 10 years up around 107%, and we can see all-time highs March 2022 over 2 years ago at $274. Now, they are expecting growth moving forwards over the next 4 quarters, and they did have a marginal miss where they released their earnings last week, so we do get a 75% track record. Nonetheless, EPS expected to grow, with forward P coming down to just below 19. Now, we get a very safe dividend score at 88. We get undervaluation on dividend yield, which we will come to show you, but very disappointing that increase in July this year at 3.1%. In terms of the last recession, while they increased the dividend, they had below average growth, but they still outperformed the S&P negative 42%. And this is why we say very poor, given the fact over both the last 5 and the last 20 years, they have been increasing those dividends at a double-digit rate. Nonetheless, they have been consecutively increasing those dividends 17 years. In terms of looking at this valuation model, well, over the last 12 months, we can in fact see right now trading right towards the lower end. And when we look at dividend yield theory, right now the yield is higher than the 5-year average. The forward P is below the 5-year, although you could also justify purely on these models reasonable valuation. And right now it sits bang in line with the overall industrial sector at 19.5. Now, free cash flow payout below 60% is what we see nearly every year. 66 in 23, lower over the next 12 months to 53%. Free cash flow has also doubled or more than over the last 10 years. Growth expected over the next 12 months. And when we get to sales growth, understand this is a cyclical industry, and that is shown through the numbers. In fact, 5 of the last 10 years, including 2023, have been a decrease. Therefore, when we do zoom out and look at it from a numerical perspective, we can see a lot of ups and downs. Now, in terms of shares outstanding, one reason why we love this company, returning a lot of excess cash to shareholder pockets, going from 901 million in 2014 to 610 just in the latest period. Then in terms of ROIC, very consistent. Remember, we do pay a premium for consistent companies, looking good around 15% in 2023. And the operating and free cash flow margins both above the minimums. In fact, operating, we get a little bit of operating efficiency, and free cash flow margin looking very strong and very, very healthy. Net debt to EBITDA, probably one word of caution. It is one that has been increasing from 2014. We want to see this reverse, which we note over the next 12 months, but something just to keep an eye on. Ideally, we don't want to see them take on a significant more amount of debt, given it is fairly high to the maximum 3 point. Then we get to our valuation. Well, we see this at 258. Wall Street clearly see this higher, 275. They see upside of 20% over the next year. And with us, in terms of an MOS, today we pretty much see it around the 10% point. But again, for those that want to see, at 15% a buy at 219, at 20% around 206, at 25% around 193. So today's episode, UNP, 10% MOS with 20% upside. Does it make it onto your watch list? Does it make it onto your buy list? Or maybe you prefer other railroads like Canadian Pacific, like Canada National Railway. We then move on to Nike stock, in fact one that Bill Ackman disclosed as a more recent buy in his portfolio. We get a double buy rating with a hold from Quant. This one has started to come back down to its 52-week lows with a forward yield of 1.88%, a forward P of 28, and in fact over the last 12 months down 24%, over the last 10 years up only 70%, and we can see it pretty much come down from the highs of 3 years ago at $178. Now, as we can see, they are anticipating the next 3 quarters to be double-digit decrease to the earnings per share year on year. However, the previous 4 quarters, they have beaten quite significantly management estimates, and they do expect over the next full year this to continue to increase, with the forward P coming down to just below 24. Now, another very safe dividend score of 99, massive double undervaluation signal, and they increased the dividend 8.8% last November, so we should expect one coming very soon over the next few days. Now, last recession, they increased the dividend, they had above average growth, and they also outperformed the S&P negative 36%. Last 5 years and last 20 years, double-digit growth. Hopefully, we see that for shareholders over the next week. In terms of dividend growth, well, 22 years of consecutive increases, 40 years of paying a dividend without a reduction, and as we can see, based on the forward P, right now, this is below even the lower end of this expected price, giving us the undervaluation signal, and we can also see the yield is massively higher than the 5-year average, as well as the forward P below the rolling of 31.9, so a double undervaluation signal there. However, consumer discretionary does sit much lower at 13.9. Question is, in this market, do you believe Nike deserves a premium for the company? In terms of the actual payout ratios, well, we can see 33% in 2024 expected to go very high over the next 12 months to 86%, so maybe we don't see the greatest dividend increase over the next week. Something to bear in mind, but it isn't the be-all and end-all of this company. Then we get the free cash flow per share, where it has been very, very inconsistent, although doubled over the last 10 years, expected to drop massively over the next 12 months. And in terms of sales growth, we can see flat in 2024, not really a good sign for what was or has been considered a very large and strong brand. Over the last 10 years as well, it has gone from 30 billion to 51, and they have done share buybacks, but not every single year and not for large amounts. ROIC looking good consistently as well, are in the 20s over the last few years and on a trailing 12 month. Both margins looking very inconsistent. On the operating side, it is above the minimum that we want to see, but we get no efficiencies whatsoever. Free cash flow margin again, inconsistent, but for the large part above that 5% level, 15% on a trailing 12-month basis. What we do love about this company though, net debt to EBITDA very low, 0.05 in 24, an increase expected but still small, 0.27 over the next 12 months, showing us that it has a great balance sheet and that the dividend, as we saw, 99, very, very safe. Now our intrinsic value at $98, with the MOS at 10%, a buy at $88, at 15% at 83, and in today's episode we see a 20% MOS for this company, with Wall Street likewise in fact seeing 20% but to the upside with their price target of $93.50. Is this one you are considering, as it is starting to come down to the 52-week low? We then move on to what we believe to be one of the best semiconductors to own over Nvidia in terms of the growth potential just over the next year. We get a double buy rating from Seeking Alpha and Wall Street, a strong buy from Quant, trading in the mid to lower end of the 52-week range. It is Applied Materials AMAT, forward yield 0.86%, forward P below 22. Over the last year, massive strength, up 43%. Over the last 10 years, massive outperformance of the S&P, up 754%. They are also expecting growth over the next 4 quarters and have also outperformed by a decent margin in terms of management expectations, with the EPS expected to grow, lowering the forward P to 19.2. We also get a very safe dividend score, with massive growth to the dividend itself at 25% in March this year. In terms of the key metrics, well, they maintained the dividend during the last recession, didn't increase, didn't also cut it, negative 38% in terms of sales, and a near S&P return, negative 57%. We also see very strong growth over the last 5 and the last 10 years, and when we take a look at the number, they've increased it over the last 6, with 18 years being paid without a reduction. Now, in terms of looking at the valuation based on the forward PE, there is this overvaluation sign. In fact, it's looked that way over the last year, where it has shot up by more than 40%. And then when we get to the yield theory as well as forward P, we see the yield not too far off the 5-year, with the forward P sitting above the 17.8, although we do notice it is lower than the overall sector of information technology at 24.3. In terms of free cash flow payout, well, below 50% for semiconductors, in fact very low, 13% in 2023. No surprises why we got that very large 25% dividend increase. 20% on a trailing 12-month basis. Then we get to the free cash flow per share, where it has increased, but remember this is a very, very cyclical industry, and we do notice a small drop anticipated over the next 12 months. And for being a very cyclical company, one of the best, because when we look at others in the semiconductor space, they have many years of negative growth. This company just won in 2019, although we can see their top line has slowed to pretty much around the inflation rate in 2023. Nonetheless, though, it has pretty much tripled from 2014 to 2023, and they've also bought back a lot of shares over the last 10 years, so definitely something to consider in your overall investment thesis. ROIC looking very strong, above the 12% and increasing, 34 in 2023. And when we get to the margins, we also notice operating efficiency, 17 to 29 in 2023, and the free cash flow margin looking very, very strong, 25 on a trailing 12-month basis. What's more, it's well below the 1.5 that we want to see as a maximum, 0 in 2023, 0 on a trailing 12 month, 0 over the next 12 months. It won't even take Applied Materials 1 day to pay off all of their debt net of cash on hand. Now our intrinsic value at $237, when we get to it in terms of MOS, well, 10% a buy at 213, at 15% a buy at 201, and we keep going, and what in fact we see, you're getting at least a 20% margin of safety around the $190 mark. 25% you would have to wait for around $175. In terms of Wall Street, they see a price target of $243. They see upside of 31% over the next year. So 20% MOS, 31% upside for this semiconductor company. Is it one you are considering? There are also some other great alternatives like KLA Corporation as well as Lam Research. As always, give us your thoughts about these 8 undervalued dividend stocks. Are you buying, holding, or maybe you have sold in the not too distant past? If you've also enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter. We are dropping a new model coming on Monday morning, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.